Welcome to the Parry Wealth podcast. I'm Ian Townshend, and this podcast features a conversation with Parry Wealth's Head of Advice and Chair of the Investment Committee, Ewan Rosie. I grabbed Ewan at Parry Wealth's head office to pick his brains on all things investment charges. We spoke about how a typical investor would invest their money, what charges they might pay, what they don't know that they're paying, what the evidence suggests is good for investors, and ultimately how costs factor into portfolio construction. I hope it challenges your thinking. I hope it helps you to make some good investment decisions and ultimately leads to you getting some better results. Thanks for joining us today, Ewan. We're obviously here to talk about all things investment charge related. Let's dive into the charges then. Broadly speaking, can you give us some examples of what charges an investor might be paying and how that might vary depending on kind of the way that they're investing?
Sure. I guess this is where I really feel for investors, because trying to work out the true cost of an investment can be extremely difficult because of all the different layers of charges that are placed upon an investment. And there's a bit of a theme in that some of these charges are explicitly stated and have to be stated because it's a regulatory requirement. And then there are other charges that aren't stated and are hidden away and that are just, quite frankly, impossible for an investor to try and work out. So I guess at the very simplest of levels, there's a product fee. So if you invest in, say, an ISA or a pension, there'll be a charge for that. Sometimes there are entry fees on these products. Other times, well, hopefully very few times, there are exit fees on these products, which mean you have to be tied into them for a period of time until you can take your money out. Rather scandalous, frankly. And then kind of the more normal way is to have some form of ongoing sort of monthly fee for using the ISA or pension. And this could be wrapped up within a platform fee, which is kind of the more modern way to do it if you're accessing these sorts of products through an online platform. I guess the most common fee that investors will look to is the fee that is placed on the underlying investment fund. And this is currently known as an ongoing charges figure, or an OCF, as it's abbreviated to. And this is the latest name update in what has previously been called an annual management charge, or AMC, or a total expense ratio, a TER, which I'm sure no investor really understands what that name means.
So these are all different ways that the regulator or someone else has tried to give investors a way of judging the kind of overall cost of an investment, right?
Correct, and I guess each has been challenged because they actually don't include all of the costs that are available to them. So, as things progress, they're trying to capture things that have been left out in the past, but we're still not quite there, frankly, with the latest ongoing charges figure, because whilst an investor might think that this is the total cost of their investment, unfortunately that's simply not true. And when you get underneath the bonnet, there are things like dealing costs. There is a measure of dealing costs called portfolio turnover, which is there to show just how much that fund is buying and selling, because obviously if a fund is making more buy and sale purchases, then there will be higher costs associated with that fund. So clearly it depends on the investment strategy as to how big a charge that would be. There are also things like stamp duties, or what are sometimes known as dilution levies, and also things like research costs as well, which will be packaged into the fund but won't have an explicit cost available for the investor. I guess alongside that as well, there are also potentially investment advice costs. Now, to be clear, at the moment, I'm not talking about working with a financial planner or advisor here. I'm specifically just thinking about investments. And for example, say a discretionary fund manager who is a financial professional employed to manage a portfolio of investments. Now, they will charge an investment managed fee as part of the creation of a bespoke investment portfolio. And this will be a percentage that will also be subject to VAT, something that investors often miss as well.
Okay, and a lot of people in the high net worth private client space are still using discretionary fund managers. That's a pretty common solution, right?
Yeah, absolutely. Yeah, there's a point in time where discretionary fund management was seen as the benchmark of the investment world, there to cater for different market conditions. A financial professional who could make investment decisions based on kind of what they think of the economy or markets or that time. It's not how we invest money at Cooper Parry, because we look at the academic evidence of investing and prefer a different route. And actually, all of those decisions that a discretionary fund manager can make can just increase the costs, which takes away from your returns.
Okay, no, makes sense. So with that in mind, I guess, and people listening to this will be using discretionary fund managers, they'll be using the different approaches that we've covered. Why is it so important that we're aware of the costs that we're paying? Why is it so important that we have transparency on those? I guess in lots of other areas, if you pay more, you get more. But is that the case with investments?
Well, to answer that question with a very straight answer, no, it's not the same with investments. I think in lots of other walks of life, I would completely agree, but in the investment world, this is simply not the case. And as well, investors, we struggle with the concept because of how it counters most other areas of our life. If we wanted a high performance car, for instance, you might go out and buy a Porsche, you wouldn't buy a Ford Fiesta. Or if you wanted a great cinematic experience at home, you would buy an expensive OLED TV or something like that. Yet, if we want great investment performance, we should buy a low-cost investment fund. It kind of goes against the grain of kind of everything else that we're kind of taught to believe in. Part of the reason for this is the marketing machine of the investment industry. Higher costs means that these investment managers have big marketing budgets, and this drives kind of the wrong message to the investor. One of the areas to highlight are so-called best buy lists that are available on certain online platforms that direct investors into specific funds, often that should not be on the best buy list, frankly, in that they are there because there is some form of payment or financial interest for both parties. Sadly, the Neil Woodford scandal and Hargreaves Lansdown are quite a topical example of this at the moment.
And really hard for investors to understand. I mean, they're given that information on a platform or in the press, whatever it might be, and they kind of trust it, right?
Well, yeah, and why wouldn't they trust it? It's such a hard thing for investors to understand. The internet can be such a great resource of information, and if you look to a well-established, successful company for advice, you should be able to trust what's on their website, and sadly in our industry you can't in lots of places. I mean, in terms of the wider message, in terms of sticking with kind of low costs and why it's important, as a company here at Cooper Parry, we have an internal investment committee, and we are always looking at the ongoing academic evidence to say what is the best way to invest our client money, and costs play a big part in it. There are firms like Morningstar and Standard & Poor's who highlight that investors are better off in low-cost funds, and they complete annual studies to back this message up every single year. This is a message that's communicated by other investment firms like Vanguard, for instance, who have been pioneers in this space in our industry, and the success of their whole company has been driven by a low-cost investment message.
If that's the evidence, and there's research and studies out there that tell you that that's the answer, why is that not the sort of solution that investors look to as a standard now?
Well, I think it comes back to what we talked about earlier, a bit like if you were paying for medical advice, for instance, and you needed brain surgery, and on one hand somebody said you could get an operation for £100, or you could pay £10,000, and you had that money to do so, your natural inclination would be, I think I'll pay the £10,000 because they're going to be better than the person offering it for £100. So there's a lot of actual education that's kind of needed to go along with investment.
Sort of reassuringly expensive.
Reassuringly expensive. And in terms of actually when you think about the returns that are available, there's only so much return that's available from the capital markets. If you can capture it as low cost as possible, then actually more of that return is going to be in your back pocket, rather than kind of giving up that return to the fund managers looking after your investment portfolio.
And it is part of the problem still that investors have been told so many lies, mistruths, the marketing machine you talked about before, that actually when we're trying to communicate this message about what the evidence suggests, there's still a level of distrust there.
I think you're absolutely right, Ian. I think our industry, as a whole, when you go back a number of years, has often had quite a poor reputation. Pensions, mis-selling, all that sort of stuff. We even see it today. You hear things on the radio like, have you transferred your pension? Have you had the right advice? There's clearly still an element of mistrust there. And actually, we see it ourselves when we kind of take prospective new clients through our wider financial planning process. As part of that, we will look to do a second opinion on somebody's existing investment portfolio, and that involves, getting really underneath the bonnet in terms of what are they paying in terms of charges. And because of the tools that we have, the analysis that we can do on investment funds, 9 times out of 10 we find things out that unfortunately the prospective client in front of us just doesn't know. And actually, when we present the full costs of their current investment arrangements to them, it's often met with a bit of surprise, possibly a bit of anger. And unfortunately, until all the charges are fully presented in a transparent way that potential clients can understand, there will always be that element of mistrust. And frankly, transparency of charges is key to building that trust and professionalism. And investors should never be making a decision from a misinformed place.
Yeah, no, that makes sense. So I guess that leads us on nicely to that work that Cooper Parry Wealth do in helping people understand their charges, but then also moving on towards how do we build portfolios with costs and charges in mind?
First of all, cost is hugely important to us at Cooper Parry when building our investment portfolios. It's one of the key areas that we look at when considering whether to include a fund within our model portfolio. So we look to build investment portfolios by screening different asset classes that we want to include, and we actually start on a lower cost basis because we believe in it that much. Important to note that cost is only part of the equation. When we have a range of the low cost funds in one particular asset class, we'll then look at the investment management technique, for instance. If the fund is tracking a particular index, we'll want to see, is that fund looking to fully replicate the index? So if it was tracking the FTSE 100, for instance, would it hold the 100 stocks in the FTSE, or would it try to synthetically replicate it by holding different assets? We would want to choose the fully replicated fund. And we would also look at things like, well, actually, how closely is it tracking the index compared to its peers, and then really making an informed decision from there. We also invest on a truly independent basis, so it's great to have no restraints when it comes to investment decisions. There are other investment firms out there, because of their restricted advice designation, they have to pick certain funds and might not be able to access the lowest cost in different asset classes because of that restricted advice. So ultimately, we feel really well placed to be able to pick investments truly on the best interests of our clients. I can give you a recent example actually of our cost mindset and a change that the investment committee have recently suggested to our model portfolios. And whether costs are large or small, if you believe in it, I think you've really got to stick to that belief. And we have used what's called an exchange traded fund in our portfolios for a number of years. And exchange traded funds have recently been subject to a change in that the London Stock Exchange is now asking for something called a legal entity identifier. So a legal entity identifier is a bit like a national insurance number for a person. It allows the London Stock Exchange to identify trades through types of pensions, companies, trusts, for instance. And this comes with an additional cost, an annual cost that our clients would be subject to every single year. It means more administration, and extra dealing costs. So within the investment committee, we did some investment analysis to say, well, is there a cheaper, lower cost solution compared to paying these costs? That answer was yes. So we made the change and kept our costs lower for our clients.
So, yeah, clearly costs are an important factor in that decision-making process around building clients' portfolios, but not the only factor. What other challenges do you think investors face with regards to cost or wider kind of investment planning, financial planning?
Yeah, I still think there are lots of challenges out there for investors. Some that they might realise and some that they won't, quite frankly. I mean, from the outside looking in, it can be a very confusing landscape. And I think there is a huge part for advice still to play. You know, making good investment choices is not easy. And as many studies have shown, you know, DIY investors don't tend to fare very well. You know, example of a flagship study is something called the Dalbar study that looks at how investors in America compare to the returns of the S&P 500 when they tend to do it themselves, and the answer, as I've said, is not very well. And the reason for this is because that investing is an emotional battle, and having a financial professional on your side of the table can really help with this battle. So my first bit of advice would be to seek help, don't go it alone. You know, the mistakes when they are made can be very big with some very big consequences. But first and foremost, you know, I advocate that an investment should never be the first decision that an investor thinks about. You know, what they should be considering is, well, what is it I want to achieve for the future? And then think about, well, actually, how is it an investment can help me get there? And what is a sensible level of risk to take with the money? Yeah, and these questions can actually be really difficult to answer without help and kind of somebody coaching you in the right direction. But where do you go for this advice? Do you go to a financial advisor, an IFA, a financial planner, a wealth manager, a restricted advisor? You know, there are so many different titles for financial professionals these days, and actually people think that they might all do the same thing, and this isn't the case. I think an investor needs to take time to understand, well, what services do they want from a potential advisor, and what are the costs of those services going to be. People are naturally cost conscious. You know, we often are in all parts of our life, but too often, you know, people are actually comparing apples with pears in kind of the financial industry today. They may be comparing a financial planner against a discretionary fund manager who provide a very different service, or worse, are often blindsided by hidden charges after they've made a decision, and that's kind of the place that we absolutely don't want investors to be. And my final bit of advice would just be, don't think about investment decisions in isolation. For instance, you could have a great investment strategy across your ISA, your general investment account, your pension, but if you're in retirement and you choose to draw down on the wrong asset, which therefore costs you a lot of tax, that itself is a huge cost that needs to be considered. But that is where the right advice can help.
Okay, well, great. Look, thanks for joining us today. Thank you for your time.
No problem.
I think it's pretty clear it's a complicated landscape out there. There's a lot for investors to think about. Firstly, kind of getting that clarity on what they're paying at the moment, understanding the bigger picture, and trying to kind of help with a financial professional who helps them create that kind of joined up plan. But look, as I say, appreciate your time, and hopefully it's helped a lot of people.